Welcome back. You're watching First Trades live on ET now. 31 points off for Nifty futures, 100 points plus for the Sensex. Markets are roaring, breath is strong, and all sectors are chipping in quite smartly. Let's connect with Sanjay Dutt, Director of Quantum Securities, joins us live from Delhi. Sanjay, good morning. Good to have you back on ET now. Sanjay, whereas the majority of the investors are confused on the street and they are finding it difficult to justify the recent rally, I'm sure you're a happy man because you got this one right.
Yeah, Nukuj, I think that's the primary reason the market is going up, because the kind of skepticism that there has been on the street for the last month and a half or so, there aren't been any believers at all. I wouldn't say believers have been a majority, but there aren't been any believers at all. And I think the market was hit at everything possible negative that it could be hit with. And you still didn't have it going down below 5100, 50, the low that we saw a few weeks back. So this is a rally which is a rally primarily emanating from oversold conditions, underinvested conditions, and of course the global backdrop improving a little, Europe not falling off the cliff at this point of time, US reasonably doing well. So a combination of these is what has contributed to the rally right now, even though we haven't had much of policy action in India.
Sanjay, we've been fed on a good dose of liquidity in the last weeks. Do you think that is last 5 weeks, that is. Do you think that is here to stay?
Yes, I think so. I think we have much more liquidity in the pipeline over the next few months for India. There is a lot of opportunity within the markets in India. Of course, we would go through the process of, 3 steps ahead and 2 steps backward over the next few months, which means consolidation, base building, as we've seen. The last 100 odd points have been pretty slow in the markets. So that process will carry on, but definitely there is liquidity and there is a good amount of supply, because the skeptics, the people who think that it's time to get out, people who've been fed up and waiting for opportunities to get out are selling into this, and that's how the liquidity is being fed in, and investors are buying into those stocks which the general public at large has been trying to get out, which includes some of the domestic large investors also.
So how should investors approach this market, Sanjay? Time to take some chips off the table because markets have gone up and they've gone up quite smartly in quick time, or it's still time to ride the momentum?
I think it's the question of rotation now that you need to look at, Nikuj. If you look back in the last few days, you had the likes of ITC and the ones which have rallied quite a bit are correcting, are pulling back. And you have the likes of Reliance, which have gone up by about 15% in the last 2 weeks or so, 2-3 weeks. So you are seeing this kind of rotation where money is moving out of certain stocks and sectors which are outperformed for quite some time and moving into sectors where investors think the risk could be taken on. So therefore you need to watch as to what you're buying at this point of time. You need to, I think, start being underweight the defensives and start being a little aggressive on the, interest rate sensitives, a little aggressive on the infrastructure, capital goods, power plays, etc. The ones that have been beaten down over the last few years. And I think more than that, if you really want big returns, you need to focus on, which I've been saying for quite some time, and of course I've been wrong with the short term, is to look at some of the good quality mid-cap companies where I think there will be a phenomenal amount of traction once the interest rate cycle and the order books, etc. start rolling in.
So Sanjay, if one had to cherry pick amongst the rate sensitives, like you just said, autos as well as banks, what would the list comprise of?
I think I would focus on the autos a little because, banks have a problem in terms of the bank balance sheet as well as liquidity which they need to capitalize some of the balance sheets of some of the larger banks we have in India. I'm not saying the banks are going to fall off the cliff or the banks are going to come off of the current levels. I think the banks need to consolidate a little. Banks won't get off to a flying start, barring intermittent rallies that you may find because of interest rate hopes, etc., and oversold conditions. I would still bet on the other interest rate sensitives where I think there's better traction. And some of it correctly you mentioned, which I heard Mr. Kampani mentioning a while back, Maruti Suziki. I do agree with him. I think that's one stock where one can invest in. I don't have positions myself, but I think it's a good bet because things will stabilize. And similarly, a lot of other players where where their balance sheets have been stretched, they need debt restructuring, they need interest costs to come down. Some of the infrastructure players, some of the capital goods players, some of the companies which have had substantial capital outlays but not been able to do equity raisings and have a good amount of debt on their balance sheets, I think they're the ones who will outperform in the next year or two.
Sanjay, aren't you betting on a perfect scenario? And the perfect scenario is that inflation will come down, Reserve Bank of India will cut rates, but the chink in the armor is the global environment. Crude is up, monsoon is bad, food prices are yet to come, so you never know if Reserve Bank of India will oblige next time.
And because I don't think that's really an issue. Even if Reserve Bank does not cut rates in the near term, that's in the next 3 to 6 months, it doesn't matter, because the point is, even if the monsoons are weak, the infrastructure, capital goods, power sector, these are some of the sectors where there will be spending. There is no choice. I think I'm saying, in fact, if the monsoons are bad, in fact, these are the sectors which will gain the most, because the government will be compelled to start doing infrastructure investments to boost employment in the rural areas, to boost employment overall, and to boost overall investment environment in the country. So, in fact, the FMCG companies would be at risk because consumer spending may go down at the rural levels. But I don't see much of a risk in the power and infrastructure, because, most of the stocks, if you look at, you look at the enterprise values, you look at the book values of the stocks, they're really down to bare bones. And if you see some of the power companies, I think one would need 5 to 8 years to actually reach to the level of execution they've already reached, in terms of land acquisition, in terms of clearances, environmental clearances, etc. And that's the gap which no one can match if one were to set up some greenfield projects. So therefore, they are the ones which would immediately start moving up as soon as the environment starts to improve in terms of the investment climate in the country, in terms of the business environment. So even if interest rates don't come off in the short term, which I mean in the next 3 to 6 months, because you correctly pointed out that inflation may not ease off, I still see infrastructure and power as areas which will outperform in the next 12 to 24 months.
Sanjay, last time when Nifty cracked below 5,000, you went long in your tactical portfolio. So what are you doing there? And in terms of the structural bets, any structural ideas you are betting on from the power space or from the infra space?
I think in the power space, some of the existing companies, I know a few companies where I've invested in which have about 6 to 7,000 megawatts of capacity up and running, but have market caps of about 9,000 crores and say enterprise values of 30-odd thousand crores, or maybe even if you took some off-balance sheet exposures of that company, the enterprise value might just be 35,000 crores. Now, and the company would have, in addition to that, another 3,000 megawatts up and running over the next year and a half or so. It's got all clearances, it's all got financial closures, but it's very tight for liquidity at this point in time. And I see similarly some of the other 2-3 large companies. Reliance Power is one of them. I don't have an investment in that, but at this point of time, you cannot get those UMPPs, you cannot get into the execution levels as what the company is at this point of time. So I think those are bets which would 100% make you money, and the risk reward is relatively favorable, because one sees downside of 10 to 15%, the earlier lows that you've seen, and upside is going to be huge as soon as things start looking up for them. So that's the place I would like to be, primarily into power, because power is one thing that would be sorted out in the next year or so, particularly after this freak incident of the grid failure, the amount of global attention India has got. Everyone in Delhi, all the policymakers and the administrators realize that this is one place they need to sort out. They're very aggressively working on the, fuel linkages for them, whether it's coal, gas obviously is a challenge. So once all these things are sorted out, I think that's the place where things will get sorted out. Look at, for instance, we've had the Yamuna Expressway opening up. I don't have a position in any of the Jayaprakash companies, but those are the assets you cannot create even if you spend 5 to 8 years. Yes, in the next 3 to 6 months, you may be frustrated holding on to those positions, but eventually I think one will realize that these are the assets to buy in these distress situations.
Sanjay, you like Maruti, you don't have a position there. You like Reliance Power, you don't have a position there. You like JP Group of Companies, you don't have a position there. So what are your positions?
Nikush, you know me very well. I wouldn't like to talk about my positions, or wouldn't like to really promote them. I find it very difficult to actually advocate my positions, particularly now, after the last 2 to 3 years of challenging times where I've lost loads of money I probably haven't lost in my career, holding on to contrarian bets. So I really won't advocate the positions that I hold, but I'm just trying to give a drift to the investor as to where they need to start thinking right now. I'm not advocating that the Reliance Power or a Jayaprakash or whatever I mentioned are the best bets, but I'm just trying to give a drift to the investors, drift to your viewers as to where they need to start looking at right now, and start to add on risk and not be too worried about policy inaction, because, you know, I'm quite fed up and tired of that policy paralysis. And I know whatever it may be, things are going to sort out in the next few months.
Okay, Sanjay, we'll leave it at that and appreciate you taking the time out and joining us as always. Quickly revisit what the market is up to. 53.97 is what the Nifty is nudging right now. The CAG report on coal block allocation, that is going to be tabled in Parliament today, and top sources have confirmed to ET now that companies like Tata Power, JSPL, Bhushan Steel, SR as well as Adani are likely to be named in the report as well for allegedly making a windfall gain of 1.8 lakh crore rupees due to no bidding of mines as well between 2004 to 2006. Nitya Balakrishnan joins in now with more details of that. Nitya, the CAG has clearly come down heavily on private beneficiaries, but what is the government likely to say in its defense?
Well, Aisha, we've picked up from top sources that the CAG final report will be tabled in Parliament today. And of course, what that does contain is a very watered-down version of the initial report, which pegged the loss due to government's allocation of coal blocks at close to 10.7 lakh crore rupees. We're given to understand that the final report indicates 1.86 lakh crore rupees is the loss caused due to allocation and not auction of resources between 2004 and 2011. We're also given to understand that the initial report did name JSPL, the likes of Tata Power, Adani and SR as prime beneficiaries. That is likely to be retained in this report as well. And the CAG has reiterated that they will have to switch to immediate auction in order to ensure that the coal sector there is fairness and transparency. We're given to understand that the final report actually lashes out at the screening committee and not at the central and state governments. But remember, the central government is facing sleepless nights simply because Prime Minister Manmohan Singh did hold the coal portfolio between 2006 and 2009, and he did not switch over to the auction route either. We're given to understand from top sources in the coal ministry that their defense is going to be the fact that there was an immediate need to boost revenue and production in the sector, huge demand from power and infra space, so they did not have any alternative. And of course, they're lashing out at the CAG saying comparing captive coal prices to that of Coal India to arrive at 1.8 lakh 6 crore rupees is simply not all right.
Nitya, thanks for that. Before we wrap, let's go to Ashwini for his mid-morning ideas.
Well, the market continues to look positive and is now breaking out of intermediate highs. So Escorts is a buy with a stop about 62, target of 71. Crompton Greaves is a buy with a stop about 117, target of 130. United Spirits is also showing fresh traction. So this is a buy with a stop about 925, target of 980.
Ashwini, thank you for those trading ideas. That's it on this edition of First Trades. It's goodbye from Aisha. Thank you for watching the show.